U.S. stock market rally hits another milestone last week. The Nasdaq Composite is up more than 20% from its mid-June low, and's longest bear market since 2008. But the rally has sparked a familiar debate: will the rebound continue? Some investors are beginning to believe the worst of this year's stock market rout may be over. Data released last week showed both the consumer price index and the producer price index fell in July, offers some hope that inflation may be at or near a peak. The labor market also remains strong. U.S. adds more than 500,000 jobs in July. Unemployment falls to lowest level in nearly half a century. Here's what it's hard for investors to predict: if the economy is in recession or near recession. Among the assets that have surged in the past few weeks, much of it was exactly what drove stocks lower during the massive sell-off in the first half of the year. Since the market bottomed on June 16, meme stocks such as AMC Entertainment Holdings Incorporated and Bed Bath & Beyond Incorporated rose 107% and 111%, respectively. Shares of some triple-leveraged exchange-traded funds, ETFs, that track the tech-heavy Nasdaq Composite also surged. The S&P 500 is up 17% over the same period, but it's still down 10% this year as inflation remains near multi-year highs. Some investors fear another punitive sell-off in parts of the market, especially if the Fed keeps raising rates longer than expected. When interest rates are historically low, investors have been rewarded handsomely by buying heavily in overvalued but often unprofitable companies. The fact that bond yields are so low makes even the riskiest stocks an attractive reason for many investors. Rising interest rates have reversed this trend. Nancy Tengler, Chief Investment Officer at Laffer Tengler Investments, said, "I can't say that this rate of market growth will continue. But whether we're in a recession right now or not, or is there a recession in the third or fourth quarter, economic growth will slow," she says. This means companies need to be more careful about what types of companies they invest in. One factor clouding investors' outlook is the debate over when the Fed will keep raising rates. Since the Fed's July policy meeting, some investors are betting the Fed will shift from raising rates to cutting rates next year to boost economic activity again. Not only did this drive the stock market rally, also contributed to a rebound in bond prices. The yield on the 10-year Treasury note, which fell as bond prices rose, fell to 2.848% on Friday, down from a peak of 3.482% in mid-June. July's CPI and PPI figures are good news for the market, and they will definitely let people know Fed to raise rates by 0.5 basis point at September meeting instead of 0.75 basis points as originally expected. But someone warned it's too early to think the Fed will change tack in 2023. Nicholas Colas, co-founder of Data Trek Research, said just one or two lower inflation readings are not enough to convince the Fed that inflation is fading. Colas says, considering that the Fed usually likes to see multiple consecutive economic data before changing policy direction, the market may be ahead.